Back last December, today's guest expert predicted a massive commodity price boom was dead ahead. And not many others shared that view back then. Well, boy, was he ever right. Commodity prices exploded in the 5 months since that video was reported. And more important, in his eyes, we ain't seen nothing yet. He predicts that commodity prices are going to continue heading higher, a lot higher from here.
We're only in the first few innings of a classic baseball 9 innings game.
Hello and welcome to Wealthion. I'm Wealthion founder Adam Taggart, bringing you back again for another week of making sense of money and the markets. And I'm very excited for today's guest. We are interviewing Steen Jakobsen, who's the chief economist and chief investment officer of Saxo Bank, which he manages billions in client assets. He joins us from Copenhagen. You probably see Steen from his work on CNBC, Bloomberg News, et cetera. I'm really excited to have Steen join us today because I interviewed him back in December, where he made a quite bold call at the time that he saw a sharp rise in inflation ahead, as well as additional government stimulus. And here we are 4 months later, and pretty much everything Steen predicted has come true. So Steen, great to have you back on the program.
Thanks for having me, Adam. Always a pleasure.
It's always a pleasure here. Well, look, Steen, again, I want to just sort of give you your due recognition for that very prescient prediction on higher inflation ahead. You called a commodities boom, which has certainly been a dominant theme of the past 2 months or so here. And you also talked about governments passing all sorts of new stimulus, both monetary, fiscal, and with a special focus on infrastructure. And really, that entire playbook unfolded right after you mentioned it all. So that was very prescient. Let's just start, though, with the question I like to ask every guest. What is your current assessment of today's economy and financial markets?
That Q2 clearly is the peak in sentiment, in valuation, in the improvement of the economic data, and that we by Q4 will have to see and do the same interview that we did in December. We will see more stimulus, because I think my core view when we talked in December was one of that we are trying to solve for 3 generational challenges at the same time, which of course is this inequality, or in the words of, I think, the new Biden administration, to some extent, social injustice, which is now fully supported by a Fed mandate to go with full employment before anything else. You have the green transformation still needing to happen. And of course, the infrastructure, which has become very much a part of the narrative since we spoke last. All of this makes things worse because we are, again, failing to understand the fundamental of what happened during February and March of 2020. And I have to say, you give me a lot of credit for being right on this call. But one thing I got wrong, and which I think everybody got wrong, was that when we sat in February and March and April, I could see as an investment manager why you should buy stock. But in the back of my head, I always had this feeling that this is going to be a very violent recession. There's no way it's going to be a V-shape. With the history behind us now, it's pretty clear that it was not a recession. It was a close down of the economy. So it was binary in the sense that it was on and then it was off, and then it was partly being open again. And to some extent, that is what has created the market we have today, Adam, because it was much better than that I perceived it to be. It was, in terms of the speed at which the move happened, was faster. So as we talk today, Federal Reserve is so far behind that they almost come full circle to be right again, in the sense that the rising inflation will do marginal higher cost of capital. The higher marginal cost of capital, combined with the slowdown in that Q data I just referenced, means that the Federal Reserve by end of the year will have to ramp up again the monetary support, and the fiscal support from Yellen and the Biden government will come fast and furious again to support this. So to some extent, we are in the same territory. The supply-demand equation has gotten worse. The actual inflation in the economy is now for real. I know for this week, we're expecting a headline number of 3.6%. If I've told you in December that we're going to be at 3.64% headline, no one would have believed me. So yeah, it's kind of interesting. We've gone full circle, and yet we have moved nowhere in terms of monetary policy, what is in place macro-wise, and the bottleneck supply chain is basically what I use and spend all my time on, because it is in shipping, in commodities, in mining. The fact is, if you want to decarbonize, then you are metallizing, if that's even a word, Adam, but then you need to go to the metal space. And renewable energy, as you have talked about extensively over the time, it's just not, there's just not enough baseload or even investment to cater for that transformation.
Wow. All right. So there's so many points to follow up on that. Let's just dive right in. Let's see where to start. One of the things that you mentioned that we talked a lot about the last time that you were on was the pressure that's being placed on the current world infrastructure, where in many ways the digital economy has become so successful that it is now constrained by the actual physical economy. There just aren't enough roads, bridges, shipping fleets,
containers,
et cetera, yeah, to meet the demand that's there. That's becoming the bottleneck. It sounds like you say you're only seeing that's going to continue and exacerbate. I'm seeing you nod there a little bit. So when we couple that with,
you see, I mean, sorry, I didn't want to interrupt you, but just look at every single earnings report that we just had, the release for the Q1. All of them pretty much I'm mentioning. Overnight, we had Kellogg CEO, we had Warren Buffett. So, back in December, I was an inflationist. I was one of these odd creatures that was so naive to think that for the first time since the 1970s, we're going to have inflation. Now, every single business person on the ground is reporting the same thing, which, by the way, was the basis for my call. It wasn't that the CPI, I mean, and for the record, CPI is absolutely and utterly useless in terms of measuring inflation. And I'll tell you why, because the 25% of the CPI is rent equivalent. And even you, a smart guy, Adam, you would expect that the rent equivalent was derived from some sort of market pricing. It's not. There is no correlation between the rise in rental and housing price in the US and the rent equivalent. So the house price in the US runs between 15 and 18% overall year over year. The price built into the like-for-like rent equivalent is less than 4%.
Yeah, it's crazy. It's in some past recent interviews in this program, I've really railed about that, which is I don't know how anybody can, let alone what the government publishes, how anybody can report on the CPI with a straight face anymore. When you're looking at every input cost that goes into our way of life going up by double to triple digits over the past year, and to report that the CPI is still below the 2% target threshold is it's insulting to our intelligence. All right, so where I was going with this is, so the physical infrastructure is going to still be a constraint going forward. There's been a ton of stimulus that's pushed a bunch of liquidity into the world, and it sounds like you see some more coming in Q4, and I want to dig into that for a moment. We're seeing lots of commodity pressure that's happened over the past couple of months. But it sounds like from what you're saying, continued constraints in the supply chain, more liquidity coming forward. It sounds like this commodity boom may still have a lot more to run. Do you see that?
We're only in the first few innings of a classic baseball 9 innings game. And the reason is, and it's kind of interesting, because if you look at the chart, you will say this is too much. And to be honest, I have one of the smartest commodity analyst in the world, a guy called Ole Hansen, who's been in the game for as long as I've been in the overall macro game. And he's been trying to at least verbally fade this move for the last 4 weeks. But I think he's ignoring one single factor, which I think is the driver right now. If you look at who are the net buyers today and why they're buying, classically, we say that the commodity market is a supply and demand market. But right now, a lot of countries are basically increasing the strategic reserves. So you see that China do realize that if they're going to fight this geopolitical risk with Australia, they need to import a lot of iron ore, a lot of metal to come into the ports of China up front relative to the long cycle of actually going to renewable energy. So I think a lot of countries are strategically similar to what they did on sanitation and vaccines, are now front-loading the commodity game by making strategic purchases through the market. And you can argue for a government whether they're paying, $8,000 or $10,000 a ton for copper. It doesn't really matter, because the plan here is, and that is clear in the case of China, they're moving from, unlike the US, a sort of a platform economy. They want to move to be independent in semiconductors. They want to be moving to renewable energy and reduce the CO2. So I think the geopolitical, if you want to use that word for it, demand is very, very big in this space, because everyone wants to be strategic about the next 5 years in terms of what they need of resources.
Okay, so let's now kind of move over. Commodities are going to continue to have that tailwind to them. Now, you mentioned that you've seen, you think that in the short term, economic growth has peaked in Q2. It's going to dip in Q3, and I'd love for you to kind of expound on that. Is it a small little dip? Is it a big dip? And then you see a big policy response in Q4 with more stimulus spending. And by the way, correct me if I'm wrong, but you're not just looking at the US when you talk about that. You see the EU and China participating in that sort of future wave of additional stimulus you see coming. So I guess first, can you just sort of clarify the arc you see there in terms of, peak, dip, and then shooting the moon again as this year progresses in terms of economic growth?
Yeah, first we need to establish a timeline. So China was first into the COVID crisis and first out. US and UK was second, and Europe is going to be the last. So what I think is happening to the global economy in terms of a synchronized response, we haven't had one. China has been very restrictive, have been tightening monetary policy relative to the rest of the world. So the full inflationary force of the world will only come, in my opinion, when everyone is synchronized. And my call is that by Q4, every single government, every single monetary authority will stand behind the fiscal expansion to forever and an easy monetary policy. And the reason for that is that Europe over the next 2 to 3 months will see their peak growth. So we are just a delayed function, but we are still asynchronic relative to the global cycle. The global cycle in terms of people who have a faster rollout of vaccination is 2-3 months ahead. So basically the data between Q2 and Q3 doesn't really compute really, but by Q4, everything will be synchronic. And the case in China to start with, which is the biggest impulse of world growth, they have such a tight monetary policy today that needs to be accommodated with a low interest rate in order not to create too much bankruptcy, to not create a stock market that comes into a free fall. In the case of US, you have this opening of the economy where you have a very interesting labor market dynamics where in most states, or in many states in the US, the support for employment benefit sits at 1.5-2 times the actual payment that these same people can have going back to the actual job market. So you will have a delayed function of up against the Federal Reserve going back to full employment or something that mirrors full employment. That will be delayed. So by delaying the reaction function of getting people from the supply side of labor to come into the actual market will delay the growth and the potential growth of the economy, meaning the Federal Reserve will be more accommodated for a longer time. That will be met, in my opinion, by the financial market with what we see today, with break-even rates breaking higher and higher. So had we had this interview 2 months ago, the consensus on the street would have been that the inflation was transitory. Now the consensus in the street is 50-50 between the Fed narrative of transitory and a cyclical inflation. What does that mean overall for me as a risk taker? It means that two things, in my opinion. Volatility goes up because it's less transparent, it's less fixed. And secondly, it means that the marginal cost of capital ultimately will go up. So why, can you ask, is the marginal 10-year not going up? Simply because, among other things, the general account of treasuries is still being reduced. It sits at 950 billion as of today. It needs to be at 500 billion in August. So think about what that does. It floats the banking system with reserves. Those reserves right now in the banking system, we have a ratio of lending to deposits, which is the lowest ever. In other words, we have never, as American banking system, been lending less out relatively to all the deposits. So most people probably realize this, but I have to make the case that when you make a deposit at a bank, Adam, you are creating a liability for the bank. That liability needs to be met by a regulatory capital. That regulatory capital is traditionally US Treasuries. So in other words, as long as you have the general account, the Treasury, floating the market with liquidity, then the banks gets too much liquidity relative to the lending they can do. That lending then moves into the pockets of buying general classified collateral value in terms of Treasury. So until August 1st, we will have that the market is sideways in 10-year. Break even goes up because the inflation is being repriced relatively to the marginal cost of capital. Post August, the marginal cost of capital will fly. We will be at 225, 250 basis point US interest rates. And of course, you know as well as I do, the world is barely functioning at 1% interest rate. If it's going to go at 2 or 2.5 or 3, immediately there's going to be a response from the political side, which is both fiscal and monetary again. So you know you're wrong in what you're doing if you're Federal Reserve, but you keep doing what you do because it's the only game in town.
Yeah, and it seems to be the only thing they can do. All right, so I've got a long list of questions, but you just zeroed in on what I got to bump to the top of the list here, which is if the marginal cost of capital goes up, that will create a drag on economic growth, right? And I think that's why you're saying you're going to see these stimulus programs coming after that. But also, it's higher rates are like kryptonite to an overvalued stock market. So you're a risk taker. And you have to, figure out how to allocate your client's capital. The question I was going to ask you is how worried are you about today's level of valuation in the financial markets? But boy, if you see a spike coming in the marginal cost of capital, just mathematically, if you do a discounted cash flow analysis, that should be bringing down asset prices by itself. How worried are you about some material market correction between now and that stimulus wave you see coming in Q4?
So there's two ways to approach this. One is statistical mathematically and one is tactically. So let's do the math first. Basically, with the valuation we have right now, with the sentiment as high as it is, with the easy monetary policy, there is less than 25% probability statistically that we will be up more than 5% 1 year from now. Doesn't mean it's going to be down 30%, but statistically, the performance of the stock markets from the starting point we have in terms of valuation is, roughly, 25% chance of being about 5% up, meaning 75% to be less, around zero or negative. But as you already know, my response, or the response rather that I expect for Fed, is more stimulus. And as you can see, as you saw on Friday, when you get a miss of what is 700,000 people on the non-farm payroll, the market is still in this phase, which we've talked about before. You need to understand the worse it is for the real economy, the better it is for the market, because the discount stays big. And so it's kind of a running, and then, I have two hats when I do and answer this question, Adam. One is that, statistically, I know it's just rubbish. I should find some way to protect myself over the next year and just relax. But I have to be active, otherwise people think I'm just lazy, right? So I have to come up with an alternative strategy. But the other side, and the technical side, is pretty simple. As you know, I run a multi-asset, sort of 100-year portfolio, similar to what Chris Cole has defined, and he's been a great inspiration in the way we run money. But I really don't mind whether the market goes up and down, because I'm monthly rebalancing and I'm making sure that, unlike most investors, I do have a component of volatility, I have a component of tips, I have a component of crypto, I have a component of CLOs, I have a component of commodities, which is much higher relatively to the average 80% long or 70% long, and fixed income on the other side. So rebalancing is really what keeps me in the game and sleeping at night. But overall, I think there is a fair chance we see a 20%, 25% correction. But I think that correction will be bought for exactly the same reason. And that's the thing you need to anticipate as an risk taker. What is the policy response to the next downdraft in the market? It is essentially that you take the market up. And again, let's go back to the way that Federal Reserve operate and how they think about the market. So they think very much in terms of financial conditions. If you look at the component of financial conditions, the most volatile component is the stock market. So the only way that the financial condition gets under pressure is basically when the stock market is under pressure. So when the stock market gets under pressure, the financial system tightens too much. And what does Fed do? They have, a policy response, a ramping up of the rhetoric of doing potential yield curve control and the size of the support they do. So it's a never-ending game that you play on the other side of this, Adam, that you have to respect that, as long as you're diversified and you are doing monthly rebalancing or quarterly rebalancing, you're okay. You can see a risk of 10, 15% to your portfolio, but net, you should get contribution that we had this year from real estate, from crypto, and from commodities, which sits outside this very long duration equity overall if you're only buying Amazon and Facebook and the likes.
All right, great. And I do want to get to talk about allocation in a little bit here. You were really kind last time we chatted, and you kind of opened the full kimono as to how you had your portfolio positioned. And if you're willing to do something similar here, I know people really appreciated it last time, and I think I'd love to hear an update. But before then, a couple of questions. So if I am distilling everything you've said so far, and of course, this is all a game of probabilities. Nobody knows exactly what's going to happen when. But you see, potential for, as we hit the peak of economic growth right about now, that Q3 will see lower growth, we'll see rising cost of capital, and we will see some efforts by the administration to get people who aren't working back into the workforce. And right now we've been paying so much in stimulus that for a lot of people, they've done the math and say, look, as long as I'm getting these stimulus payments, I'm just going to stay at home, right? It's a better trade-off than having to go work for roughly the same paycheck. So there's going to be some period of pain in there where people are going to have to get off the couch and go back to work. The markets might start correcting, maybe as much as 20, 25%, like you said. And then the central planners will ride to the rescue and will turn the money spigots back on again, and everything will kind of reinflate. So I'm seeing you nodding as I'm saying this. I guess my question to you is that makes sense to me. I can definitely see how that's probable. It certainly follows the current script that we've been following for a long time. I guess my question is how long can that game continue? Or maybe even the best question is what limits, if any, do you see on central planning here? Can they keep managing things this way by just turning the spigots on and off, but a little bit, more each time to keep this balloon, pushed higher and higher? Or do they eventually really run into real constraints that, that limit their ability to kind of just manage this whole thing? You and I, we do the math, it's hard for us to conceive that the whole system continues to work, but it does. Can they keep this going forever?
No, but they can do it for a long time. What will kill it, of course, is inflation, because even as the Federal Reserve, the yield curve control, and they're doing it indirectly in 10-year now, but 30 years still going to go up in price, which ultimately will, it's like, this better than anybody. If you have a physics system where you contain energy, ultimately it will break out. So what will happen ultimately is that you will have a catch-up effect on inflation that breaks so much, so high that it forces interest rates and a monetary response. But right now, remember, 50%, as I said earlier, at least is thinking this is transitory. So you need to get to a stage where inflation passes not 2.5, 2.8, 3, but 4% and 5% and rising with a high velocity. That is your critical inflection point where we need to have another interview and talk about how do I navigate this kind of market. But to get to that point, you have to remember a couple of things. And I listened to a very interesting interview with Dylan Grice, which I think is a very smart macro guy. And he admitted he didn't get inflation right in the 2007, 2008, but he made a very interesting analogy to MMT and the way we conduct policy. So I will assume and pretend right now the premise of this policy response is basically MMT. In other words, we can print as much money we want without an inflationary aspect. But Dylan Grice makes the point, as much as he misinterpreted and didn't understand inflation in 2007, 2008, and let me, by the way, join him, I didn't understand it either. So Dylan Grice and I didn't get the 7, 8, 9 Q expansion right. So the inflation, we didn't understand how inflation worked. But on the other hand, right now, the MMT group, people are telling you and me that they know exactly what inflation is. And I'm saying Dylan Gris is like, 100 times more intelligent than me. And everybody pretty much, he talks to has the same view that they didn't understand it. They still fully don't understand. And by the way, for the record, Volcker famously said in his book that, inflation is one of these things that people think they understand, but no one really understands, because what is inflation? But leave that aside. But the point is that the MMT is doing exactly the same mistake we did in 7, 8, and 9, thinking we know the mechanics of how inflation evolves. And then that's interesting, because someone who, like me, who's, as you can see by the lack of hair, has been around since the 1970s. I was having car-free Sundays in the 1973, 74 because of the oil prices and the supply constraints that was in the 1970s. I lived in the 70s. My parents was paying 14, 15% mortgage rates to the ridiculous little house we lived in, right? So I know the impact of what inflation does. And if you don't believe me, go back and listen and read Warren Buffett's newsletters from the 1970s and let him explain to you how difficult it is to navigate the business. So that is where we could be going back to. But the point here being that no one understands inflation. I mean, inflation, we know, if you look at it from a reverse engineering point of view, 80% of inflation is expectation. Yet everyone you've talked to, Adam, everyone in the market pretends that it is this week's CPI and PPI. It's not, because when you accept that you're going to pay higher prices for the commodity, you already have a sliding, accelerating inflation. So this afternoon, I had to go home to get a washing repairman in. I need to buy a new washing machine. I say, okay, cool. When can I have it? Tomorrow? I'm used to getting things tomorrow, right? He says, actually, I can put in the order and then we have to wait for the actual delivery because there's supply constraints. And by the way, if you need it fast, I need you to pay more. And so, in other words, I am fully willing now, which I've never been. I'm a cheap economist. I have a very low salary, so I have to be very careful how much money I spend. But I'm willing to pay higher prices for the same good that I wouldn't pay this amount for 6 months ago. I'm accepting that things has changed, and through that expectations is setting itself higher. And then there's the other thing, which is break even, which is, is at least better than CPI. But Goldman Sachs made an analysis. All break even levels have always been reached. So in other words, when you see a break even rate in 5 years US at 2.7, 2.75 this morning, then it will be at least 2.7, 2.75 in almost 100% of the time. So inflation is so difficult to navigate, to understand, to define that it's really about the at the end of the day, it's about what the businesses are doing. And as I reported before, if you look at Q1 reporting, you will see everyone talks about, the ability or inability to pass on price hikes, and how, did your DIU, have you been to the DIU store recently? Things are up 30, 40, 50%. If you want to change your tire to summer tire, whatever, it's up 100%. Everything is, it's not 2%, it's not 3%, it's 100%. So the point here being, we don't get inflation. No one understands inflation. Not me, not Dylan Gris, but the M&T crowd is arguing, going back to your question, that they fully understand it. So when they see inflation, or Janet Yellen says, yeah, we have the tools. Janet Yellen, you have no tools that can control inflation when it's out of the bottle, because it is throughout society. It's not just a small part. It's every single citizen in the US and Denmark and everywhere else who are accepting that they need to pay higher prices relatively to what they were willing to pay 6 months ago. That is inflation.
Yeah, and you're underscoring. I was talking with David Stockman a little while ago, and we sort of talked about inflation, made the analog of the Titanic, where by the time the central planners, by the time they recognize it as a problem, given their tool set and their lack of understanding and lack of experience that you've said, there's nothing they can do at that point to avoid hitting the iceberg. Right? There's so much momentum. So by the time you actually see the problem, it is way too late to avoid it. And it's really all about how do you want to just sort of manage getting into the crash position before it hits. We hope you've been enjoying this conversation with Saxo Bank's Steen Jakobsen. The interview continues in part 2, where Steen explains why he thinks gold, and especially silver, are poised for a substantial run-up from here. And even more important, he breaks down for us exactly how he's positioning his portfolio right now for what he sees coming ahead. To watch part 2, just click on the link provided in the description of this video below, or simply go to youtube.com/Wealthion. But before you go, please don't forget to click the subscribe button below if you haven't already. Oh, and if you'd appreciate a free, no strings attached portfolio review by a financial advisor who appreciates the market risks that Steen is warning of, just go to wealthion.com and we'll set one up for you. Okay, I'll see you over at part 2 of our interview with Steen Jakobsen.